Hello students and welcome to this lecture on government grants. As always, I like to start with a quote of inspiration, and the quote of inspiration for today is by Yoda from Star Wars, and it says, "Do or don't, there is no try." I like this quote because it reminds us that you either put your mind to getting something done or you find excuses not to do it. Right, as an introduction, I just want to bring under your attention that government grants are regulated by IAS 20, and government grants are considered assistance by the government to an entity in the form of transfers of resources in return for past or future compliance with certain conditions. So mostly this is related to regional development and economic and political goals within a specific location. So for example, you can have the government tell you, all right, if you start up a business and you, for example, do recycling, the local government can tell you, listen, we will fund a truck for your business if you are able to help us clean up this environment and recycle whatever trash we have collected so that we can have a cleaner environment for the people living in this area. So that's a good example of certain conditions. In rural areas, they can also sometimes tell you, for example, if you employ a number of people, we will help you fund their salaries so that they can stimulate employment in a specific area. So that is what they mean by compliance with conditions. And these conditions, there's just an unlimited examples of conditions that the government can set in order for your business to comply with it, and then they will give you some kind of assistance. If we talk about government grants, there's two types of grants that can be given. So the first grant is that relates to an asset, and the second one relates to expenses. If we look at the grants as they relate to assets, they can be non-monetary or monetary. So monetary means money. If I talk about an asset that is non-monetary, it means they give you the asset itself. So if I look at the previous truck example that I have used, we can say that they will give you the truck for whatever business you are starting to do recycling. So the truck itself is provided to you. Another option is a monetary option where they give you 1 million rand and then you need to use that money to obtain a truck of your choice. So the first type of grant relates to assets, or it's often referred to as asset-based. And if it's asset-based, you can either have it non-monetary where the asset is given to you, or monetary where money is given to you with the obligation of getting this truck or this building yourself. Right. If we look at government grants, there are two ways that we can account for government grants that are asset-based and monetary, and there's one way to account for it if it's a non-monetary grant. And the entity should have a policy, an accounting policy in place, which describes the method that we are using to account for the government grants. So if it's a monetary grant, so in other words, they are giving you money, you can account for it in one of two ways. It can be accounted for as deferred income, or it can be deducted from the cost of the asset that you are obtaining. So if they give you money, you can either say that that money is deferred income, or you can take the money amount, let's say that 1 million rand, and you will minus it from the cost of the truck that you are buying. If it's a non-monetary grant, so they are giving you the asset, then it is always recorded as deferred income. Right. So it will not be just for interest's sake. Students may wonder, but why can we not use this method for deducting it from the cost of the asset? Because then the answer will always be zero if we apply this. Because if they give you the truck, let's say the truck is 2 million, the fair value of the truck is 2 million rand, and they give you the truck, then you're going to say the fair value of the truck minus the grant, which is 2 million, and that will always give you 0. So if it's a non-monetary grant given, we don't deduct it from the cost of the asset, because it's always, the answer for that will always be 0. Right, so accounting for grants that are asset-based and a monetary value, but accounted for as deferred income. So the first one I want to run through is if you get a monetary grant and the policy is to account for it as deferred income. I always say that accounting is difficult to explain in words, and you can read a lot of accounting and not really understand. So I have created examples which explicitly show you how the recording should be done. Suppose that a monetary grant of 600,000 is given to Tech Pty Limited. The grant should be used to assist in the construction, it should read, of a building in a rural area. The building is constructed at a total cost of 1 million rand, and it is ready for use on 1 April 2021. This business has a year end of 31st December, and it is the policy of Tech Pty to account for government grants as deferred income and then recognize the grant as income over the useful life of the asset. The building has a useful life of 20 years with no residual value. In the required part, they ask you to do the journal entries as they relate to the year ended 31st December 2021 and 31st December 2022. So in the first instance, I have done some calculations just to say if we have a building, the building cost is 1 million rand. We need to have it written off over 20 years. And in the first year, there's 9 months because we're going to count between April and December. In the second year, the asset is in use for a whole year, and those answers are 37,500 and 50,000 rand respectively. For the deferred income, it is 600,000 because we recognize the government grant as deferred income, and that would be the full 600,000 that is given to us then. Now, the government grant is originally accounted for as deferred income, and then this deferred income is written off to profit and loss as the asset's time goes by. So for the first year in 2021, we're going to take the deferred income and divide it by 20 years. So if you have opted for the deferred income, it must always be written off over the lifespan that goes with the asset that the money was used for to construct. So we're going to divide it by 20 and 9 out of 12 because, again, this asset, we only started using it in April. In the second year, 600,000 divided by 20 years, and the asset is used for 12 out of 12 months. So that gives us a 30,000 rand that is now taken to profit and loss. So let's see what the journal entries will look like. The journal entries would be that you recognize that you have a building that you've constructed worth 1 million rand. The grant is recognized as deferred income, which is a liability. And then the remaining amount your business needed to pay for. So the 400,000 was either paid for out of your bank account or you still owe someone the money. The question did not indicate this. Then in 2021, we have some depreciation that we are calculating for 9 months, and that was 37,500, 37,500. And then we get to the deferred income part. So for the deferred income, we're going to make the deferred income lesser by this 22,500 that we calculated here for the timing that the asset was in use for the first 9 months. And we're going to take it to government grant income, and this is a profit and loss account. So we take it to profit and loss, and I'm going to show you just now this account, this government grant income is shown as other income in your statement of profit or loss. For the second year, we will again recognize depreciation. Now it was for 12 months, which is 50,000. And again, we take a bit of the deferred income. We take it out of that deferred income account and we move it to profit and loss, and we call it government grant income. So again, this is a profit and loss account. And it was 30,000 rand as per the calculations that we've done. If we are going to look at your statement of profit and loss for the year ended 31st December 2022, the government grant income is going to be shown as other income, 30,000, which is this journal entry. And then your depreciation will be other expenses, and it's going to be this amount shown under other expenses. For the statement of profit or loss, you're going to have your building at carry value. So under non-current assets, you're going to take the 1 million minus the 37,500 of the first 9 months, and then in the second year there was another 50,000 rand written off. This should read 2022, I believe, and another 50,000 for the year for which the building was in use fully. That gives us 912,500. Then the deferred income will be split, ladies and gents, because some of the deferred income is going to be written off as to profit and loss in the next 12 months, and the other portion remains a non-current liability. So it's going to be a current liability versus non-current liability. Under non-current liability, we're going to have deferred income, which is the original 600,000 that we recognized there. Then we are going to show the minus 22,500, which we have written there, minus the 30,000, which we have written there. And then you will see I have minused another 30,000. And this is simply, let me just see if I can get it to a shape. This is simply the 30,000 for the short term that has gone to stand under current liabilities. So in the next year, we've seen for 12 months, the deferred income to be recognized every 12 months is 30,000. So I'm just moving this 30,000 to deferred income, which is now a current liability, because in 2023, we will be recognizing 30,000 Rand as profit and loss. So it's not a non-current liability anymore, because a non-current liability says it has a lifespan of more than 12 months. Right, moving along, accounting for grants that are asset-based and monetary with a monetary value, but it is deducted from the asset's cost. So here we are now doing an asset-based grant. It is monetary, but we deduct it from the cost of the asset. So this is a different policy. They need to state that the policy is to deduct it from the cost of the asset. In this instance, we are going to do the following, and I've taken the exact same example, but I've now changed the policy to it's written off against the asset's cost, the government grant. Again, we need to do the journals for 2021 and 2022. So now in 2021, we're going to recognize the building at 400,000. And we're going to show that that was the 400,000 that we had to pay for ourselves. So we took the whole 1 million Rand of the building cost and we minus the grant against the cost of this asset, which was 600,000. And then the depreciation for 9 months will simply be the 400,000 over 20 years times 9 months. So if we minus the grant from the cost, we will only recognize the portion that our business is paid for. So if your business hasn't paid for any portion of it, it will be 0, 0, and you will have no depreciation to account for. So there will be nothing to journalize. For the year 2022, it's going to be the same, divided by 400,000 divided by 20 years, but now it's going to be a full year, 12 out of 12, which gives us 20,000 Rand. So it's pretty simple. If it's written off against the cost of the asset, we just minus it from the total cost price. How about if we have a government grant, but it is asset-based, non-monetary, and we have to account for this deferred income? So in other words, we are now, in terms of our mind map, we have a non-monetary grant, and it always needs to be accounted for as deferred income. Right. And I've taken the exact same example, I think. No, we have a new example. So suppose that a non-monetary grant is given to Tech Pty Limited. The grant is provided in the form of a fishing license, and the fair value of the license is 150,000. So here we have an intangible asset. The fair value is 150. The fishing license is ready for use on 1 June 2021. Then they say the business has a year end of 31st December, and it is the policy to account for non-monetary government grants through the recognition of deferred income. The license has a useful life of 5 years with no residual value. And again, journal entries for 2021 and 2022. So here we're going to say we increase our intangible asset by 150,000 and we show the government grant, the fair value as deferred income, 150,000. Then we have some amortization that we need to account for. You will remember if you have an intangible asset, we measure what we call amortization and not depreciation. So for amortization, we're going to take the 150 divided by 5. And the 7 months were arrived at because it was 1st of June through to 31st December. And that gives us 17,500 Rand. Now again, that for the deferred income, a portion of it needs to be written off to profit and loss. And we are going to move it in accordance with the assets usage. So it's the 150,000 of this deferred income divided by 5 years, and then the fishing license, which has been in use for 7 months, is used as a basis for which we recognize this deferred income as other income in profit and loss. For the year ended 2022, we're going to have 150,000 Rand, which is the license that we've recognized as an intangible asset, divided by 5 years lifespan for a full year, which gives us 30,000. And similarly, we're going to take this 150. So for the intangible asset amortization, we do the 150. For the deferred income, we use that 150. So the amortization was 30,000, and for the deferred income, we moved to profit and loss at 30,000 Rand as well, because it was the deferred income of 150,000 divided by 5 times the months for the current year for which we have used the fishing license. Right, pretty straightforward. Then what if we account for grants as expenses, right? So at the beginning of the lecture, I stated that we have an instance where a government grant can cover an asset or it can cover an expense. So now we've spoken about assets that are monetary or non-monetary. So if it's non-monetary, it's deferred income. If it's monetary, it can be deferred income or written off against the cost of the asset. If we talk about expenses in terms of government grants, we can have 2 types of grants that are used to cover your expenses. So the first one is in the form of a subsidy. So here we can subsidize, or the government can subsidize our employee cost, for example, or they can even subsidize things such as maintenance costs. If the business that you are running is important and maintenance need to be done to ensure that economic development continues in that area. So it is whatever expense you incur, but the government helps you to subsidize that expense. The other option is that they can grant you a government loan at a low interest rate. That's another expense because now our interest payable or our interest expenses is being reduced by a government grant. Right, so let's look at the first option if you have a government subsidy that is helping you pay for your expenses. And the example that I've used here is that Tech Limited has negotiated with the government to partially fund employee salaries for a period of 3 years. The total grant is worth 1.2 million. Tech Limited employs 10 employees. In year 1, each employee gets an annual salary of 100,000 Rand, and in year 2 and 3, salaries will increase by 7% respectively. Construct the journal entries for the first year and the second year. How will we treat this if they fund your expenses? So the first thing that I've done is I've just gone and calculated the total of the salaries. So each employee gets 100,000 Rand in year 1. Then I have increased it by 7% for year 2, and then by another 7% in year 3, because it does state it's 7% respectively, which means 7% on 7% for each year. Then I have gotten to totals 107,000 and 114,490 for year 3 by increasing 107 by 7%. Then I've calculated the total salaries by timesing it by 10. because it says that our salary account is for 10 employees. So there will be 100,000 times 10, 107,000 times 10, 114,490 times 10. And then for the total salary account, I got to a total of 3,214,900. And now I have used these totals as fractions to decide how I am going to recognize the grant for each year. So in year one, I'm going to take the 1 million divided by this total, 3,214,900, and I'm going to times it by the 1.2 million. And the 1.2 million is the total of the grant. For the second year, I'm going to take the 107,000 divided by this total times the grant. And in the third year, I'm going to take the 114,490 divided by the total times the grant value. So in year one, I need to recognize of this government grant, I need to recognize a 373,262. For year two, I need to recognize a 399,390. And in year three, I need to recognize a 427,348. Right, so this is my calculations. I use my total salary as weighings to decide how the grant will be apportioned through the years. Then for year one, I'm going to say I get into my bank account 1.2 million rand because this is money that the government is giving me. I recognize it as deferred income, but then I've calculated how much of the deferred income should be written off. And now I'm writing it off against my employee salaries or my employee remuneration account, which is your profit and loss account. It's your expense account. So the expense account will become lesser by the amount that we've calculated for year one. So if it were to be repairs, you would write it off and repairs would be lesser. If it were to be your water and electricity account that they are funding, you're going to write it off and the water and electricity account will be lesser. So you take a bit out of the deferred income and that bit of deferred income is used to minimize that expense account. That's why they say they are funding the government grant is funding your expenses. Right. In year two, you're going to say I take a bit of money out of my deferred income and I move it against my employee salaries. And again, I'm going to use this amount. And of course, you will have a repetition of this journal for year three, but you will use the amount 4,273,48. Right, pretty simple. It's deferred income and it is written off against whatever expense the subsidy is for.